mutual fund investors have learnt over the past few months that many Indian promoters have relied heavily on pledging their shares and have raised money from their mutual fund schemes to support their core and non-core business activities, and the sharp fall in the prices of pledged shares has resulted in a huge problem for mutual funds and for NBFCs. We are going to discuss these and other credit problems with Somashekar Vemuri, the Senior Director at CRISIL Ratings, and Anant Narayan, the Professor at SP Jain Institute of Management and Research. In a minute, we are also going to be joined by Jayesh Mehta, the Managing Director and Country Treasurer at Bank of America. Well, before that, do we have what we chatted with Nilesh Shah of Kotak Bank? Okay, Nilesh Shah put up a strong defense yesterday when we were quizzing him on why loans against shares and the standstill agreements are not dangerous for mutual fund investors. Since he's the man in the hot seat, let's listen in to the defense that he put in, and then we are going ahead with this discussion.
Mutual fund industry has paid 1,30,000 crore in income category in a market where it is difficult to sell. Shouldn't you be giving credit to us for repaying 1,30,000 crore in a market which is illiquid?
Oh, come on,
I
Nilesh.
think we should get Paramvir Chakra for that.
Nilesh, that's not fair. Nilesh, it's your duty to repay the money when people ask you back. I don't think you can get a Paramvir Chakra simply for giving back money to investors, which is their money anyways.
Ma'am, there are banks which have to repay obligations, but they get refinance from RBI. There are insurance companies which have implicit guarantee of Government of India behind them. Mutual fund industries does not have any guarantee. Yet, in a market which is illiquid, we are repaying thousands of investors, thousands of crore every day.
Basically, there are 2 or 3 questions before the credit market. One, what if promoters don't pay up? Will we have a problem with mutual funds? And 2, the larger problem that NBFCs have faced. After all, promoter or loans against shares is only one problem. They already have a problem of very tight liquidity, which will pass on to perhaps builder loans defaulting, and that could be a second credit problem. To discuss whether this can destabilize, become a systemic issue, or are these problems that are handleable, we have Anant Narayan, Somashekar Vemuri, and Jayesh Mehta. Good morning, gentlemen. Thank you very much for joining us. Somashekar, let me come to you first. Before I come to the valuation of pledges not invoked, do you think there is a systemic problem here? Nilesh yesterday went on to say that even in these promoter instruments, at a higher haircut, there are buyers. HNIs are buying their products, ARCs are buying their products, and therefore there is no risk to the investor, even in a credit risk fund. Are you sufficiently reassured, Somashekar?
So let me start by adding a caveat that CRISIL has not rated any of these debt which is backed by pledge of shares. That said, our estimate of the debentures which are backed by this pledge of shares is about 40,000 crores. And if you look at even the NBFC space which gives loan against shares, put all of that together, maybe it's about 1 lakh crore which is outstanding in the market. So from a systemic perspective and the size of the market, it is just about 1 lakh crore, which is not very, very large, and it's not concentrated in 1 or 2 names. So that is a point I would like to kind of highlight. That said, when you are looking at the credit risk of these instruments, very clearly you need to look at, essentially these instruments are usually rolled over and refinanced. They are never actually repaid. And the ability to refinance clearly depends on what is the extent of cushion which is there in the market value of the instruments that are held at the holding company level vis-a-vis the debt which is there at the holding company level. And there needs to be sufficient amount of buffer that these covers will need to offer to withstand any volatilities in the equity share market. Also, one point needs to be noted is, unlike retail loan against shares where there are very, very small holdings and the market will have the liquidity to absorb it even if the covenant breaches happen and they're not honored. Here you are really talking about very, very large stakes of companies which are pledged and potentially could result in change of control, etc. So will the market in the Indian context have enough liquidity and depth to be able to absorb that? in case these triggers are breached and in case they need to be sold. I think that's a question which remains.
Yeah. No,
Bit
that
of a
point is taken. That point is taken, Somsekhar. You know, the Reserve Bank also in 2014 warned that if there are a very high amount of pledged shares, there could be a tendency of the promoter to hollow out that company, to run it down. And then, you know, even when the pledged shares are invoked, he doesn't lose much. So there is a threat to corporate governance over there. But just one clarification, did you say promoter pledges are normally repaid or refinanced? What is the trend normally?
The trend is usually they are rolled over, they are refinanced.
They're rolled over. Rolled over.
Yeah.
Okay, that is the point. So now, Jayesh, to come to you, this 1 lakh crore, if it has to be refinanced, who will refinance? I mean, banks clearly have been scared away. They have rules as well. Now, NBFCs and mutual funds have kind of burnt their fingers. So if it is not if it is not repaid, who will refinance them? So there is a default down the year?
Yes, I think very clearly, I think this market moved to NBFC because banks anyway cannot refinance because banks have a regulatory ceiling on loan against shares, which falls as a part of the capital market exposure. So they have like 40% of your net worth. More than that, you cannot really go into capital market exposure, which includes direct exposure in equity, which cannot be more than 20%. So in reality, both this NBF real estate and loan against shares market actually moved to NBFC because banks really cannot do that. So that's the basic genesis. So basically, NBFC's edge over construction finance, banks can do it, but they can't do real estate land acquisition finance, which NBFCs were doing. And then, of course, loan against shares. Now, in terms of yes, as Somsekhar said, mostly pledge of shares by promoter generally gets rolled over. I think we were actually the pioneers to start both this construction finance and loan against shares way back in 2004-05. I think the norms in last few years, people have like kind of diluted a lot, right? So when you do promoter financing, you actually try to restrict what is the percentage of pledge he's doing, not only with you, but with the market. Because, you know, you might do 20%, somebody else might do 20%, somebody else might do 20%, there's no liquidity left, right? So technically, if you restrict that as a lender, and if you have a covenant where they need to take approvals from you, then you will always, even if the price falls, generally you are prepared, even if the price falls dramatically, you have enough pledge of shares coming in.
Okay. So even standards have fallen, had fallen in pledge covenants, you're saying?
Yes, the standards have fallen, and I think there was, you know, if you look at the boom in last 5 years or so, particularly on the NBFC side, I think that's where the aggression started, and of course, then you had the credit fund. You know, I heard your argument on credit fund. I'm not defending Nilesh, but all I'm trying to say, I think when people invest in credit fund, it is same as equity, right? So, you know, people feel that equity, 100 rupee equity becomes 10 rupee, nobody is bothered about. But, you know, if you're in debt fund and a credit fund, if your credit is impaired and it becomes 60 rupees, then everybody makes a hue and cry. And, you know, that's what the thing is. So real NAV, you know, if you pass on, then there is no problem.
I also think something like this has not happened in a very long time, right? A fear of a systemic risk. So I think that's the shock value that's hitting a lot of investors as well. In equity markets, every 2-3 years, you see something like this happen where share prices fall so much. But let me get Anant Narayan into this picture as well. Anant, what's your own view? Do you think the problem is much bigger than what it seems? And do you expect this to become a systemic risk?
Well, there is a problem, Sonia. So, except I don't think it's probably being made out to be a lot more than it is. Look, we are a growing economy. No economy is perfect. No market is perfect. And we will stumble our way through and go ahead. But absolutely, there are issues, and I can list 4 of them. First is there is a question mark, rightly or wrongly, about this entire trustworthiness of the credit rating agencies and what they come out with, especially after the ILFS event earlier. Second bigger issue is on suitability and appropriateness. Look, this particular instrument of lending against shares, look at the payoff to the investor. If things are going well, they get a debt return. If things suddenly turn sour, they start to face the same risks as an equity holder. So effectively, it's an instrument which you can argue gives you a debt type of a return for an equity type of a risk on the downside. Now, do you really have investors being made aware of the nature of the risks that they are taking on, rightly or wrongly? Third, there's an issue of governance. Look, a lot of these bonds have been structured such that the fact that effectively the equity is pledged is not disclosed. They just put up as a part of the covenant somewhere that there'll be a top-up of the shares if necessary. And effectively, the fact that the promoter doesn't have control on those shares is not disclosed to the overall larger community, which is a problem as well. Fourth, on valuations, and valuations not just for these particular bonds, but for the entire set of corporate bonds. December end, we had 6 lakh crores worth of corporate bonds on the books of mutual funds. The monthly volumes in December, whole of month, was only 1.8 lakh crores. Most of these 6 lakh crores, as Nilesh says, are good bonds. They're not bad bonds. But the secondary market liquidity simply isn't enough to handle these kind of volumes. And we are producing NAVs every day. So the problem is our markets have probably grown too quickly, too fast. And the infrastructure to support this market doesn't exist, which means we have a problem at our hand. Though these problems look egregious, I think they're manageable. We will get through with them. We stumble our way through. I don't think it's the end of the world. But yes, there are some hard decisions to be taken here.
Nilesh told me, and all mutual funds say, we put all the credit risk, caveats on our website. But, IFAs who sell them to investors don't even know about it. They may not be mis-selling, they're totally ignorant of it. And the investor is even more ignorant. So maybe we should have some very clear disclosure on credit risk funds that you could be in risk of even losing your capital. So simply saying mutual funds are subject to market risk is not enough. You should say there is no market and that the principal can be negative. Principal can go down. I think that clarification has to come. I don't think credit risk investors are aware of that at all. But the point on NAV, Somashekar, if you can come in there, we asked all credit rating agents, many of the credit rating agencies into this discussion. Several of them didn't come, I think, because they do the valuation, and you have agreed because you don't, you're not in this pledge shares rating. But tell me, is the rating being done properly when the collateral has diminished so much in value? Are the rating agencies adequately reflecting it in downgrades? If they are not, even otherwise, as Anant pointed out, when credit risk instruments themselves are full of bonds that are not traded, is there a risk that the NAVs are being overstated?
So let me come to the first question. Since we have no ratings in this space, it will be difficult for me to comment whether somebody else is doing an appropriate job or not. I can clarify, what our approach is and how the current market operates. The current market is operating at cover levels of 1.3 to 1.7 times, which means that for a debt of about 100 rupees, you will have a pledge equivalent of 130 to 170 somewhere. The different transactions have different covenants. Whereas when we look at rating of any of these kind of structures, we would look at covers which are upwards of 6 to 8 times for us to be anywhere in the A category or so, which typically is where the market has an acceptance. So I think there is a very big difference in terms of what our standards in terms of the buffer that we would look for, which will cover not only for the safety of rating, but also cover for market volatility and give a cushion in terms of absorbing shocks. So clearly, I think there is a need for having appropriate standards for rating such products. And as I said, these are usually rolled over or refinanced, not repaid, and hence the capability to refinance or rollover depends very clearly on what is the kind of cushion that is available in terms of the overall market value of the holdings that the holding company has vis-a-vis the debt which is there sitting in a variety of holding companies, and also the quality of the underlying operating companies. You are right. In terms of valuation especially in a illiquid market, I think it does pose a challenge. But in terms of our practice, we do the best that we could in terms of quoting when there are no.
Somashekar, I'll tell you the actual evidence. Immediately after the ILNFS issue, and this is actually documented, I think, in an IDFC paper, I'm not very sure, in October, November, AA paper yields had risen by 130 basis points. But A paper yields were shown as risen only by 30 basis points because they are not traded. They are this polling by rating agencies and then, so, clearly that valuation by rating agencies needs to change, isn't it? It doesn't seem to be working, Somsekhar.
So that is something which, Latha, I don't look at. There is a different team in rating. They would, in our CRISIL, which would be in a better position to answer that question. So I would not be able to comment on that.
Okay, Anant, I just have one question for you because you did bring up this issue of disclosures. Now, SEBI, as we know, is the regulator for mutual funds and RBI is the regulator for NBFCs. So what needs to be done by both these regulators now? On NBFCs, how should the RBI make sure or rather discourage these lenders, especially NBFCs, from entering into such agreements with companies? And on SEBI, what are the disclosures that need to be done in order to, secure investors?
Well, Sonia, I think it's fine for this kind of lending to happen as long as you rightly mentioned, there is appropriate disclosure and there is awareness of what people are getting into. If an NBFC wants to lend against shares and it's allowed to do so, as long as the promoter discloses and makes it abundantly clear to all the stakeholders that his shares are pledged, that should be fine. If it's being done in a form which is effectively a pledge but not shown as being pledged, that's a problem. Then that's where the governance issue really comes in. I think the broader issue which SEBI and RBI have to address is this whole question of secondary market liquidity. Look, everybody wants capital markets to grow. SEBI is saying every company over 100 crores has to borrow 25% of its borrowing from the capital markets. RBI is saying large exposures, perforce have to approach capital markets and borrow money from there. Everybody is pushing flows into capital markets. Now, therefore, to find fault with mutual funds for growing AUM to the size they have is wrong. The problem is we don't have secondary market liquidity to sustain that kind of infrastructure, right? And there are plenty of reports. Since the time I had a lot more hair on my head, we've been writing reports saying what needs to be done to improve capital market liquidity in this country. There are, starting with RBI, for instance, RBI Act being amended so that they can start to accept AAA paper at least as part of the liquidity adjustment facility. Growing repo markets, having trading volumes grow with people like you and me starting to trade in bond markets, just as we trade in equities. There are a whole host of things that need to be done. Stamp duty, for instance. That part is not being addressed. And I think that has to be the starting point because, the problem is all these issues about loans against, lending against shares, etc. is a small portion of the overall. We have 28 lakh crores of corporate bonds outstanding. This is a very small portion out of that. Now, the problem is the largest section, which is actually good quality paper, simply doesn't have the infrastructure to stand on its own legs. So which is why when we have a panic situation or a near panic situation in September, the whole system starts to shake, which is wrong. And that starting point of getting secondary liquidity is the area that we all have to concentrate on.
Okay. Yeah, we have to wind up the conversation, but, I'm worried about just two issues, and Jayesh, I want to speak to you about that. The first one that worried me is that in this credit risk fund, 65% are in below AA paper. Now, if there is an outflow, you can't sell that A and below paper because there is no market. You would have already exhausted the AAA that you have. So will there be a problem for those funds? Now, the answer that mutual fund guys gave me is that even for that A, they can sell it to HNIs. It's not as if there is no market. Only the appropriate haircut will have to be shown because these guys will normally demand 13, 14%, even 18% in yield. So, is there no systemic risk but only a fall in NAV that we should worry about in credit risk funds?
So I think two things are really required. See, I think one is, as you said, distributors explaining whether the credit risk fund is between debt more and equity, and more, when when you have defaults, it's more actually becomes equity. So I think that needs to be understand to people, not to hide away. Like we had, forget loan against shares, we had a corporate default in one of the mutual funds 2-3 years back, and everybody made it hue and shine. Yeah, if it is credit fund, there is a default going to happen. Otherwise, that will pay a government security yield, right? So that's number one. Number two, in terms of liquidity, I think that's where we have to analyze. looking at the volumes, like you have equity market NAV also happening at the previous day's closing price. But does that really mean that you can actually sell at that closing price outside Nifty 50 stocks? You can't, right? So that your repayment will come on that day's closing. So NAV is a reflection. So when you redeem, and the next day, in a lot of this credit fund is T+4, they have time. And when they actually sell, that's what you will get as your NAV. So that transmission should happen fast, then there is no problem. Yes, there is risk because you are getting higher return. Now, whether that higher return is priced well. But most importantly, what has happened right now, and that is where, post-September, I think the flows, some of the investors are actually saying that I don't want NBFC paper to the mutual fund, right? Now, if that goes on rise, then the rollover stops, so it's more like a mini run. Now, if that blows up, that can become a problem. So it can happen. So it's not blaming the industry. It can happen. The run can happen on a bank, run can happen on anything. We saw that in 2008,
Jayesh.
right?
Jayesh, I'm sorry I'm hurrying you, but we have to wind up the conversation because we have to take a mandatory break. Anant, Somsekhar and Jayesh, thank you very much for joining me. I know this conversation could go on. The specific issue really is whether the mutual funds are valuing the paper properly when they are exiting, and also whether enough disclosure is being made.
I think that's most important, right? So people know what they're getting into when they invest their money.
Investor education, certainly. I'm very sure RBI and SEBI will come out with rules, but will not want to scare the market right now.